After one of the sharpest interest rate hike cycles we've ever seen, more and more property investors are finding themselves in over their head. And as a result, many are dumping some properties. So will bailing investors be the catalyst for the next downturn in house prices? Or will this ultra expensive housing market just get more expensive? I'm Biko Konstantinos, and that's what we're going to talk about today. If you'd like to own a $6 million property portfolio like the newly elected RBA Governor Michelle Bullock, why don't you subscribe to my channel? Seriously, nearly every government member and RBA board member seems to own multiple properties. Does this give you an indication that maybe they know that all their policies create so much demand for property that prices are almost guaranteed to rise? If we ever see them starting to sell, we'll definitely know that it's time to get out of property. Not all property investors are in massive financial trouble and looking to offload some properties. It's the ones that are highly leveraged, which means they've borrowed a lot against their properties and basically owe large amounts of money to the bank, who are currently getting smashed due to recent interest rate rises. Now, during COVID, when interest rates basically fell to zero, many people got enticed to buy investment properties because they could easily service their large loans because the interest rates were so ridiculously low. But now that that's all changed, a large number of property investors are losing money on their properties. Or in other words, their investment properties are negatively geared. More than 4 out of every 5 investors in Sydney and Melbourne who purchased property since the start of the pandemic are now negatively geared. So the majority of recent property investors, especially where housing is expensive like Sydney and Melbourne, have a negative cash flow on those properties. So what that means is that the rent that they're receiving for the properties is less than all the expenses incurred from owning that property. What we're seeing since the pandemic is mortgage rates increase faster than rents, although rents have increased very quickly, said senior economist Paul Ryan. The balance has shifted and some recent property investors are getting absolutely smashed. Not only have recent investors been hit by surging interest rates, they're also seeing other expenses increase, such as property management fees, council rates, insurance, repairs and maintenance. The proportion of property listings in Sydney that were investor owned reached a record of 39% last month, and nationwide the proportion of investment properties being listed grew to 32%. CoreLogic's head of research pointed out that investors generally have higher mortgage rates than a principal property owner, which makes the recent rate hikes really pack a punch. They suggest that some of these property investors don't want to risk their family home, which is why the choice for them might be obvious to sell their property investment. Now, one thing that could help these investors and the entire housing market from collapsing is the negative gearing tax deduction. Now that so many properties are losing money, the amount that's going to be claimed for negative gearing is going to skyrocket. So the government is going to pay billions of dollars in tax deduction for property investors with negative cash flow. This negative gearing tax deduction policy really is a bit of a get out of jail card, and it's one of those policies that really help build speculative demand into property, because even if that property is losing money, you get a rebate which helps you hold on to that property while you wait for massive capital appreciation because of all the speculative demand. So the Prime Minister and the new RBA Governor own lots of property. Isn't that interesting? Let's listen to famous auctioneer Tom Panos for his take on property investor selling.
Wow, wow, wow. Up to 75% of the stock in certain parts of Australia are owned by landlords. I said it on this platform 2 weeks ago. The investor sell-off has begun, and today in the Fin Review, it has been validated with data.
Tom says that the investor sell-off has begun, so let's check out this data. This table shows the portion of investor-owned listings. So in other words, out of all the properties for sale in an area, how many of those properties are owned by investors? So we can see 3 suburbs in Western Australia where the portion of investment properties are actually over 70%. And when you compare this to 12 months ago, you can see there's been a significant rise in investor property listings. And going down this list, all of these suburbs have property investment listings over 50%, with the most expensive areas being Stanmore, New South Wales, Forest Lake, New South Wales, and Parklea, New South Wales. Does anyone have any local knowledge of any of those suburbs on this list? I'd love to hear your thoughts of what's really happening on the ground. So it's clear that the number of investment properties for sale is increasing, but will this be enough to send house prices lower?
Example, Stanmore, more than half the properties on the market are investment type properties. Now, why has this happened? Because you had all these smart investors 2 years ago working out if they borrowed money at 2% and they put in all their other expenses, that they wouldn't have to chip any money out of their own pocket. Now that game's over, and even though rents have gone up, what's happened is nowhere near to the level of their mortgage repayments.
So during COVID, with the RBA dropping interest rates to zero and then forecasting that they wouldn't rise until 2024, basically created wild speculation in the property market, which included property investors because they would have thought, I've got 3 or more years where I only have to pay 2 or 3% interest. So because the interest payments are so low, the rents could cover basically all my expenses, so I could have an investment property without having to put in any additional income, and then just realize those capital gains, which is more Australian than Vegemite. Remember in Jerry Maguire when Tom Cruise says, "Show me the money"? Show me the money! Well, in Australia, it'd be "Show me the bloody property gains, boy," because Australians know all you have to do is hold that property and the gains will come. And many investors might have loaned as much as they possibly could. And it's those investors who now could be in over their heads.
And how investors got smashed? They got smashed on their principal place of residence, they've been smashed on their investment properties, and they bought investment properties with the view that they wouldn't have to chip in. They always thought that you'd have this buffer. You'd be getting 2% mortgage rates, and that you'd be getting a return of around 3-4%, and you wouldn't even have to negative gear. But guess what? That game is over.
I'd like to point out that property investors have had a golden run over the past 15 years. And that's because interest rates have been ultra low. Since May 2013 and a decade after that, the cash rate's been under 3%. And you can see it kept getting lower and lower, and with COVID went all the way to near zero. That's a decade of ultra cheap debt. And when your repayments are low as a property investor, there's not that much risk, and as long as you can rent your place out, it's been relatively easy to cover any additional expenses that your rental income doesn't cover. That's why Australian housing property's been the closest thing to a sure bet for many years now, because we've had ultra cheap debt combined with extremely generous tax deductions. Because if your expenses are greater than your income, you're able to claim that loss against your actual earnings, as in your job, which means you can often get a tax refund, which helps investors keep those properties that are making a net income loss. So it's only with these sharp interest rate rises recently that have brought some significant risk to property investment. And the big question is, will interest rates stay higher for longer? And if they do, there's going to be additional risk for property investors, which is how it should be in my opinion. When you make a speculative investment, there should be risk involved, because that means investors need to be more careful with their purchases and not just continually bid prices up and up, but it's this lack of risk and continuous gains year after year, which has resulted in a massive speculative housing market, which many believe closely resembles a Ponzi scheme, because you always need someone new to pay higher and higher property prices to enable property to keep growing faster and faster than wages, which is why we're currently in this housing affordability crisis. If investment properties did contain more risk, there'd be less overall speculative demand, which could help to improve housing affordability, which we desperately need in Australia, New Zealand, Canada, and many other countries. So we're starting to see some cracks form in the housing market, with recent property investors being caught out by surging interest rates. But will those cracks be enough to send house prices plummeting, or will ultra generous tax deductions like negative gearing and record immigration levels keep supporting house prices so the housing market Ponzi can continue forever? Side note, all Ponzis eventually collapse. I'm Biko Konstantinos.